What if a company shows record-breaking profits while secretly drowning in losses? Welcome to the world of the invisible profit illusion. In the high-stakes arena of corporate finance, inventory isn't just boxes on a shelf, it's the lifeblood of the balance sheet. But behind the polished glass of the boardroom, those numbers can be manipulated to tell a story that doesn't exist. Tonight, we peel back the layers of deception to uncover how fake inventory can manufacture fake success, leading to a reality that eventually shatters. From phantom stocks to double-counted assets, we explore the shadows of the warehouse floor where billion-dollar lies are born. What happens when the truth finally catches up? Stay with us as we expose the mechanics of inventory manipulation fraud. The numbers flash green, but the reality is a deep crimson red. Is the inventory real, or is it just a ghost in the machine? Why is inventory the perfect tool for fraud? Because it sits at the intersection of profit and valuation. In accounting, more inventory often translates to lower cost of goods sold, which miraculously inflates the bottom line. It's a lever that executives can pull to boost investor confidence and secure massive bank loans. You can fake a sale once and the cash trail might catch you. But you can fake inventory for years, hiding the rot deep within the racks. It's the ultimate illusion because auditors can't count every single item in a global supply chain. This vulnerability creates a playground for those under pressure to meet impossible targets. When the stock price depends on a number, the temptation to change that number becomes a gravitational pull. In this scene, we see the calm before the storm, the polished exterior of a thriving company that is built on a foundation of empty boxes and ledger entries that exist only in code. Fraud rarely starts with a grand plan for evil. It starts with pressure. Imagine a quarterly deadline approaching. The margins are thinning, the bonus structures are at risk, and the board is demanding growth. The pressure trickles down from the C-suite to the warehouse floor. For a manager, the choice feels simple: report the truth and face the fallout, or adjust the count just enough to bridge the gap. It begins as a temporary fix, a promise to make it up next quarter. But the gap only grows. This is the fraud triangle in action: pressure, opportunity, and rationalization. In the silence of the night, the decision is made. Permissions are overridden, and the first fake entry is logged. The atmosphere is thick with suspense, a corporate thriller playing out in real time. This isn't just business. It's a desperate gamble where the stakes are entire careers and the future of a global enterprise. The pressure cooker is about to blow. Method 1. The inflated closing stock. It is the most basic yet most effective mechanism in the fraudster's toolkit. By simply increasing the reported value of the stock at the end of the period, the cost of goods sold decreases. Mathematically, this forces the gross profit upward. Just one number change on a spreadsheet can create millions of dollars in imaginary profits overnight. It's a magic trick performed with a keyboard. Watch as 5,000 units becomes 15,000 with a few keystrokes. No physical goods moved, no sales were made. But on the balance sheet, the company looks healthier than ever. This paper profit satisfies the banks and keeps the stock price climbing. It's a digital lie that feels like success until the day someone actually tries to sell those non-existent units. The illusion is seamless, integrated into the very software designed to prevent it. In the world of forensic audit, this is the first red flag hidden in plain sight among thousands of lines of data. Sometimes the inventory never existed at all. This is the phantom inventory, assets that live only in the ledger. In large-scale operations, auditors often rely on test counts, checking only a fraction of the total stock. Fraudsters exploit this by creating detailed records for items in remote locations or third-party warehouses that are never visited. System dashboards show full racks, high-value components, and ready-to-ship products. But when the drone flies through the actual aisles, the silence is deafening. The racks are empty, covered in a layer of dust that tells the true story. It's a haunting visual, a billion-dollar company whose greatest asset is literally thin air. To maintain the lie, Security footage might be manipulated or access to certain secure zones restricted. The phantom stock is a ticking time bomb, a financial void that consumes the company's liquidity. The system says in stock, but reality says gone. This is the ultimate ghost story of the corporate world, where the spirits are made of debt. The double counting trick is a masterclass in logistical deception. It's a simple concept. One box, reported 3 times. In a complex global supply chain, goods are constantly in motion. Fraudsters report the same inventory as stock on hand in the warehouse, goods in transit on the high seas, and consignment stock at a third-party location. By the time an auditor moves from the warehouse to the shipping records, the paper trail has been carefully synchronized to show the same value in multiple buckets. It's a shell game played with cargo containers. A ship in the mid-Atlantic and a warehouse in Chicago both claim ownership of the same 1,000 units. On the consolidated balance sheet, the asset value triples. This requires precise timing and deep access to the ERP system to ensure the phantom movement doesn't trigger automated alerts. It's a high-wire act of data manipulation where one slip in the schedule could reveal the entire scheme. One asset, multiple reports. A recipe for a manufactured fortune. Not all fake inventory is missing. Sometimes, it's just dead. Welcome to the obsolete inventory cover-up. In industries like technology or fashion, products have a shelf life. When a new model is released, the old stock becomes worthless. Standard accounting rules require these items to be written down to their real market value, a move that slashes profits. To avoid this, companies keep dead inventory financially alive. The books show a warehouse full of premium, high-value assets, but the reality is a graveyard of outdated tech and expired goods. It's a financial taxidermy, where worthless items are stuffed with fake valuations to look healthy on a balance sheet. Auditors walking the floor might see boxes, but they won't realize the contents are unsellable. This creates a valuation bubble that eventually bursts when the company is forced to liquidate. Dead inventory doesn't pay the bills, it just hides the truth. It's a silent rot, hidden behind a facade of premium pricing and optimistic projections. Fraud fears surprise audits. But in the corporate world, surprise is relative. When an audit notification arrives, the scramble begins. This is cycle count manipulation. The art of moving goods faster than the auditor can count them. Pallets are secretly reshuffled overnight. Stock that was counted in Zone A is moved to Zone B before the auditor arrives there the next morning. It's a logistical race against time, a frantic ballet of forklifts and clipboards performed under the cover of darkness. The goal is to create the illusion of a full warehouse using a limited amount of real stock. If the auditor sees the same pallet twice in different locations, the lie is sustained. Warehouse managers and staff become involuntary accomplices, caught in the frantic need to protect the company's image. The tension is palpable. Every headlight and engine roar carries the risk of discovery. This is the front line of the fraud, where the physical reality is manually altered to match the digital deception. The truth is always one step behind the forklift. Modern fraud doesn't use pens, it uses permissions. In the era of digital transformation, the ERP system is the gatekeeper of truth, or the facilitator of lies. Sophisticated inventory fraud now happens at the level of database architecture. High-level access overrides allow executives to bypass standard controls. They can backdate entries, delete transfer records, or create virtual warehouses with a single click. These digital footprints are often buried deep within millions of automated logs, making them nearly invisible to traditional auditing techniques. The dashboard might show a perfect green-lit supply chain, but the code underneath has been compromised. It's a battle of algorithms. The fraudsters use technology to hide the rot, while forensic auditors use AI to find the anomalies. This is white-collar hacking, where the goal isn't to steal data, but to manufacture it. In this scene, we see the cold, clinical nature of tech-enabled fraud. A few lines of code can hide a multi-million-dollar deficit. Permissions become the ultimate weapon in the war for profit. For a while, the fraud feels like success. The fake inventory boosts the stock price, triggers massive bank loans, and secures multi-million-dollar executive bonuses. On the surface, the company is a market leader, a success story celebrated in financial magazines. But behind the champagne toasts and the glowing quarterly reports, there is a hidden cost: anxiety. The fraudsters are trapped in an ever-growing lie. Each quarter requires a bigger manipulation to cover the previous one. The imaginary assets on the balance sheet don't generate cash. They just create a temporary illusion of solvency. It's a financial Ponzi scheme where the investors are the banks and the returns are fake numbers. The tension builds as the gap between reported profit and actual cash flow widens. The executive knows that eventually the music will stop. Fraud is a high-speed chase where the destination is always a brick wall. Success is the mask. The reality is a desperate struggle to keep the illusion alive for just one more quarter. Reality, however, always demands cash. The breaking point always comes. Inventory fraud eventually converts into a liquidity crisis. While the books show billions in assets, the bank account is empty. Suppliers go unpaid, and they stop shipping raw materials. Production lines that once hummed with activity now sit silent and cold. The banks, sensing blood in the water, begin to panic. They demand audits, they freeze credit lines, and they look for the physical assets that were promised as collateral. The invisible profit illusion finally shatters. You can't pay employees with phantom stock, and you can't run a factory on paper entries. The cash flow crash is sudden and brutal. The company that was too big to fail is now a skeleton of its former self. This is the moment of impact, where the digital lies meet the physical reality of a failing business. The graphs don't just go down, they fall off a cliff. The dominoes have started to tumble, and there is no way to stop the chain reaction. The fake success is over, the real destruction has begun. The truth always lives on the warehouse floor. When the forensic teams enter, the game is up. They don't look at the polished reports. They look at the barcodes. They scan the pallets. They check the seals. And they compare the physical reality to the system's claims. The variance is staggering. For every 1,000 units reported, they find 10. The phantom inventory is finally exposed for what it is: a void. The investigators move through the aisles like archaeologists uncovering a lost civilization of fraud. They find backdated logs, hidden transfer records, and the digital footprints of the overrides. Each scan is a nail in the coffin of the corporate lie. The data mismatch tells a story of systemic deception that reached the highest levels of the organization. This is the clinical, methodical process of uncovering a billion-dollar crime. No more theories, no more optimistic projections, just the cold, hard facts of a physical count. The warehouse floor is the ultimate witness, and it never lies. The investigation has only just begun, but the conclusion is already written in the empty space. The collapse of a major company is a global event. As the headlines break, the shockwaves travel through the markets. Investors lose billions in hours. Employees, many of whom had no idea of the deception, walk out of headquarters with their lives in cardboard boxes. The corporate logo, once a symbol of prestige and stability, is now a mark of shame. This is the corporate collapse domino, where one lie brings down an entire ecosystem. Pension funds are wiped out, suppliers go bankrupt, and the reputation of an entire industry is tarnished. Fake assets create real destruction. The fallout isn't just financial, it's human. The betrayal of trust by those at the top leaves a trail of broken careers and shattered lives. In the cold light of day, the invisible profit illusion is revealed as a reckless gamble with other people's money. The company is liquidated, the assets are sold for pennies, and the names of the perpetrators are etched into the history of financial crime. Real destruction, born from fake numbers. The end is swift, and the silence that follows is absolute. In business, numbers tell stories, and sometimes they tell lies. The tragedy of inventory manipulation is that it could happen anywhere there is pressure and a lack of oversight. It is a reminder that a balance sheet is only as honest as the people who sign it. As the lights go out on this story, the question remains for the next boardroom, the next warehouse, and the next investor. Behind every record profit, behind every surging stock price, there is a physical reality that must exist. The next time you see a company achieve the impossible, ask one question. Is the inventory real, or is it just another illusion waiting to shatter? The warehouse is dark now, the ledgers are closed, and the truth has been told. But in the world of corporate secrets, the next story is already being written. Be careful what you believe. Numbers don't lie, but people do. Good night. If you want to understand the secrets behind corporate fraud, like, share, comment, and subscribe to Corporate Secrets.